Welcome to Tesla Deep Dives. The topic today, the FSD Valuation Reset. Why Tesla killed the $8,000 upfront purchase and the financial implications of recurring revenue. Introduction, the FSD Valuation Reset. For a decade, Tesla sold full self-driving on a singular powerful premise that it was an appreciating asset, an investment that would one day turn your car into a robotaxi worth over $100,000. That narrative officially ended when CEO Elon Musk announced on X that effective after February 14, 2026, the $8,000 upfront purchase option for FSD would be discontinued. The core shift, from asset to service. The move makes FSD supervised exclusively a subscription service, currently priced at $99 per month in the US. This financial engineering is a critical pivot. At the previous price, the break-even point against the $8,000 upfront fee was nearly 7 years of continuous subscription, which many buyers were unwilling to commit to. The shift lowers the barrier to entry, accelerating software adoption over upfront revenue. The why: low take rates and cash flow volatility. The decision was necessitated by disappointing customer uptake. Tesla CFO Vaibhav Taneja noted in October 2025 that only about 12% of the global fleet had paid for the FSD package, showing the high price barrier stifled growth. By moving to recurring revenue, Tesla aims to mitigate the volatility of lumpy, large one-time sales and secure a more predictable software-as-a-service or SaaS income stream. Executive commentary and the appreciating assets funeral. Elon Musk's public statement was direct. Tesla will stop selling FSD after Feb 14. FSD will only be available as a monthly subscription thereafter. This effectively puts the appreciating asset narrative to rest. Wall Street analysts like Gordon Johnson of GLJ Research were quick to react, stating, "That story now looks retired," arguing the change is an admission that FSD is a service, not a proprietary terminal asset. Financial implications deep dive. The SaaS valuation uplift. For investors, the change is a double-edged sword. On one hand, it creates a new paradigm, allowing analysts to apply higher SaaS-like revenue multiples. One projection suggests that if the FSD take rate triples from the reported 12% to 40% of the fleet, the total revenue generated from 100 cars over 5 years could surge from $80,000 upfront to $237,600 subscription. Near-term headwinds and analyst skepticism. The immediate market reaction was mixed, with Tesla stock, TSLA, dipping following the news. Analysts like those at UBS, while adjusting their price target higher, still maintained a sell rating, citing near-term cash flow pressure during the transition. The immediate loss of a large $8,000 one-time payment for each sale creates a short-term cash flow dip that the market is watching closely. The public reaction, the $15,000 buyer backlash. On social platforms and forums, the dominant negative sentiment comes from early adopters, especially those who purchased FSD at its peak of $15,000 in late 2022. They feel they paid the equivalent of over 12 years of the current subscription price for a perpetually supervised product, while new buyers get the same access for a fraction of the cost, a clear case of customer liability and discontent. The strategic edge, data and competition. Beyond revenue, the subscription model is a strategic tool to generate more data. By lowering the entry price, FSD gets into more hands, accelerating the accumulation of the billions of training miles required for future full autonomy. This is crucial for competing against rivals like Alphabet's Waymo and Rivian's new Autonomy Plus system, which is priced aggressively at a one-time $2,500 or $49.99 per month. Conclusion: a necessary reset for long-term value. In summary, the FSD valuation reset is a necessary, albeit painful, pivot for Tesla. It's a pragmatic shift from a failed appreciating asset fantasy to a real, modern SaaS business model. While it creates a short-term cash flow headwind and generates negative sentiment from legacy customers, the overall narrative dominating institutional investment is positive. The move provides stable, recurring revenue, broadens the user base, and aligns Tesla's valuation framework with that of a high-margin software company, unlocking significantly higher long-term potential. Monitoring and forward look. Key metrics. Investors should monitor 2 key metrics for the next 12 to 18 months. 1. The FSD take rate. It must demonstrably rise above the 12% baseline to validate the pricing strategy. 2. The churn rate of the $99 per month subscriptions. Low churn will be the strongest indicator of the software's improved value and the long-term success of the new recurring revenue model. A material drop in the subscription price, similar to the $199 to $99 drop in 2024, would signal adoption is still struggling. Let me know what's your thoughts and leave your comments. Thank you for joining us for this deep dive. To ensure you never miss a pivotal analysis, please like the video, subscribe to the Tesla Deep Dives channel, and hit the notification bell. Your engagement fuels our critical research.